Welcome everyone, and thank you very much for joining us for our Financial Planning Pitfalls and Solutions event for expats in America. In this event, we'll be covering retirement planning, investing, and currencies in 3 15-minute segments, followed by a Q&A session. I'm joined today by 3 expat financial experts: Drew Waterbury from Ocean Advisors, Brian Dunhill from Dunhill Financial, and Kelly Cutchin from Moneycore. Drew is a certified financial planner with over 30 years of experience. He previously worked for the New York Stock Exchange firms before founding Ocean Advisors to help families who wish to create generational wealth through financial planning and investment strategies. Brian is CEO at Dunhill Financial, a financial advisory and asset management provider for expats with a core emphasis on concentrated positions and retirement planning. Previously, Brian worked for Wall Street firms including UBS, Lehman Brothers, and A.G. Edwards. Kelly has been country manager for Moneycore's USA operations based out of Orlando, Florida since 2012, where she leads a team of foreign exchange experts and works closely with the firm's global offices. Drew, Brian, and Kelly, thank you very much for joining us. And how are you today?
Thank you for having us.
Yes, thank you, Hugo.
See you, Hugo. Thanks again.
Great. Before we dive in, would you all please submit your questions for our experts in the Zoom Q&A function? And our experts will endeavor to answer them all, time permitting. So without further ado, I'll hand over to Drew to talk about retirement planning for expats in the US.
Okay, thank you, Hugo. So what I'm going to focus on here are the 401 and the IRA options for US employees. And these are both really great plans for saving for retirement. They offer a couple of really good characteristics that I'm going to be reviewing here. I'm going to be talking about taxes, how they're different from a tax standpoint, contributions, and then the investment characteristics of these 2 different types of plans. So let's start with the taxes, right? So from a tax standpoint, and right now I will talk about the Roth feature, but let me focus right now on the traditional 401k and traditional IRA. The contributions that you're making to either of these plans are going to be tax deductible. So use an example here of someone who's making $50,000 a year in salary. Let's say they make a $5,000 contribution to either one of these plans. That's going to reduce their taxable income by $5,000 for the year. So let's say they've knocked it down to $45,000. Now, once you've made that tax deductible contribution to your plan, then you're in what I call the accumulation years. And let's say that's 20 or 30 years, maybe more, that money and investments will be tied up in your 401k or your IRA. You receive preferential tax treatment here too, because events that would normally be considered taxable and things that jump to mind are capital gain distributions, interest, and dividends. These are things we would normally pay taxes on, but not under the umbrella of these types of plans. Those are we're not going to be taxed on them. So it allows our money to work that much harder for us during this accumulation period. Now, eventually we'll retire. And I want you to think about this as a bookends. We have our years when we're making our contributions, and we're on the other end, we have the years that we are going to be making withdrawals. Because at that point in our life, we're no longer working, we're in our retirement years, and we need to live off of the savings that we've made through our accumulation years. And when we take a distribution from the IRA or the 401k, at that point in time, we are going to be taxed. But the advantage, the assumed advantage, is that we're no longer working, right? So we should be in a lower tax bracket. So with a traditional IRA, think of the bookends. We've got the tax deduction up front. We pay the taxes on the distribution. And in between, we get all that accumulation and investment opportunity over 20, 30 years in which we're not paying taxes. Many of us are familiar with the Roth feature. You can have a Roth within a 401k. You can have a Roth IRA. The difference here is the way the taxes are treated. With the Roth, and I'll go back to that other example, $50,000 salary, you're making a $5,000 contribution. You will pay taxes on the contribution to your plan. It's not something you'll be able to deduct up front. During those accumulation years, treated the same as the 401 as the traditional plans. You're not paying taxes on dividends, capital gains, interest payments. And on the opposite end, the far book end, when you're starting to take the withdrawals, the advantage to the Roth is that you're not paying taxes at that point in time. So the tax advantages of using these plans, whether you use a Roth or whether you use a traditional, obviously is going to vary on your individual circumstances, what you're trying to accomplish, your investments outside of your IRA or your 401k. They both offer very significant tax advantages to saving for retirement. Another thing we need to talk about are the contributions that will take place, because obviously you need to fund these types of accounts. Now, the 401k is a corporate plan. So you'll be making contributions, assuming you're a participant within the plan. You don't have to be, but let's assume you're a participant within the plan. Your contributions to the plan will be a salary deferral. So with each pay period, part of your paycheck has been earmarked to go directly into your 401k for the accumulation, savings, investment over the next 20, 30 years, right? In addition to your contribution, there's what's referred to as the employer match. And the employer wants to create an incentive for you to participate in the plan. And they do that through a match. Now, there are limits to how much they're going to match on your contributions. And it will vary from plan to plan. Not all these plans are going to work alike. There are parameters within the terms of the matching, and there are some strings attached. The vesting schedule. That's one of the ways that companies encourage you to stay around a little bit longer. They'll say, okay, we're going to contribute money into your 401k, but you have to work with us for a certain number of years before you have 100% ownership of that 401k match contribution. I keep referring it to this as a match contribution. I want anyone who's listening to this to think of this as free money, because that's ultimately what it is. It's a way to encourage you to participate in the corporate retirement plan by giving you free money in the form of the match. So if you find yourself working in the United States and they offer 401k, make sure that you are at least contributing enough to take advantage of the matching plan. Within the IRA, it's not a corporate plan. So you as an individual have to make your own contributions to the plan. And that can be done a number of ways to make it simple. You can do a draft off your checking or savings, or you can wait to certain points of the year when your budget allows and make contributions to the IRA at that point in time. It's important that you know that whatever your contributions are to either the 401k or the IRA, you always own those balances. So if you're participating in ABC 401k plan and you decide that you're going to go work for XYZ company and they happen to have a 401k plan, you don't forfeit your savings. You have a couple of options. Assuming that XYZ will accept a transfer, you can move the money from ABC directly over to XYZ. You want to make sure you do the paperwork right so it doesn't become a taxable event. If you look at XYZ company and you think, well, I'll contribute while I'm over there, but I don't really like the investment lineup. I want to spread my wings and my options a little bit. You also have the alternative of rolling over the ABC 401k into an IRA. So it's important to understand that you're never going to lose access to the money that you've contributed to these plans. Let's talk about the investments that show up within the 401k and the IRA and how they're different. Within the 401k, the plan sponsor, ABC company for this example, they have predetermined the investments from which you can choose in your 401k. There's going to be a limit to how much you can invest, not how much money, but what your options or your alternatives are going to be. I've seen anywhere from 10 options to 20 investment options on this menu. I've even seen more than that. It's going to vary from plan sponsor to plan sponsor. But the reality is that there's going to be a limited amount. Typically, these are going to be mutual funds only, maybe something called a collective investment trust, which for all practical purposes for someone within the 401k is going to be an IRA, unique to that 401k. The difference between a 401k and an IRA is that when you're investing within an IRA, you have thousands and thousands of investment options. You can use mutual funds, similar to what is available within a 401k. You can also own individual stocks, individual bonds, other investments that are not going to be available within the 401k, using covered call strategies, et cetera, et cetera. So the IRA really provides you many more alternatives for your investments. Regardless of how you're looking at your 401k or an IRA, I think it's very important that people keep in mind that this is going to be part of your overall strategy for your financial plan, and the investments that you're using either in your IRA or your 401k has to be invested with an eye towards the bigger picture, how it fits into your total financial plan. One of the things that we see within the 401ks is that more and more companies are using what they refer to as auto enrollment. So if you become an employee of ABC company, you are automatically enrolled in their 401k plan. I encourage anyone who's working in that type of situation with a company who has that policy, take a look at your 401k, because number one, my guess is the contributions that are being made, if you fall under that auto enrollment, are not going to be enough to get you to financial security in your retirement years, number one. Number two, most of these auto enrollment features will put you in a default investment. Typically, that's a target date fund. That target date fund may or may not work into your overall investment strategy. So I'm going to wrap this up here with a couple of observations. Number one, when it comes to contributions, I've discussed the taxes. You can't, in my estimation, whether you use a traditional IRA or 401k or a Roth, you can't lose from a tax strategy. Okay, so they both have really good features there. From a contribution standpoint, the 401k is clearly the winner, because with the 401k, you can contribute. In 2023 is going to be $22,500 to your plan. In addition, you'll be getting employee matching dollars. And if you're age 50 or older, you can actually make additional $7,500. So you can put a lot of money into a 401k. Within the IRA, it's not as competitive as the 401k. You can contribute $6,500 a year in 2023. You have a $1,000 catch-up contribution if you're age 50 or older. Both plans are good because they allow you to put money away in the tax advantage ways that we discussed earlier. But clearly, in my estimation, the 401k is better from that standpoint. From an investment standpoint, because of the large number of alternative investments that are available for you, I think the IRA is clearly the winner from an investment standpoint. Which one would work well for you if you're a cross-border employee? Well, maybe this is a good point for me to say hello to Brian and let Brian take that and run with it and offer his observations.
Thank you, Drew. That's a beautiful analysis of the entire retirement scope in the United States. And everything works impeccably for those expats that are moving to the United States and intending to stay in the United States. But some people might be transplants for a period of time. You're in halfback country, Drew, for anybody in North Carolina. They know a lot of people move down to Florida from New York, and then they come halfway back to North Carolina. Some people will do the same thing and go to the United States for a period of time and then make it halfway back or all the way back home. Now, that doesn't mean that you shouldn't look at IRAs. Like Drew said, if your employer is matching your 401k, it's free money, even if you have additional tax back home or any place else. But there might be questions of what you might want to do in between. There's certain countries like here in the UK, Canada, France, Belgium, they're actually very, very kind to 401ks, IRAs, and any retirement plans back in the United States. We even recognize Roths here in the UK. So if you're moving to a country that has a kind double taxation agreement when it comes to IRAs and Roths, maximize everything you can. Other countries like Germany and Spain are not as kind as what you might have in the US or the UK. So you might think of a few different strategies. One of the strategies might be to try to take money out of these types of instruments before you move back home to Germany or Spain. Another one might be that you take some time outside of Germany or Spain, an elongated holiday. The key is that you don't want to do this before you're 59 and a half, because then you'll accrue an extra 10% penalty on the US side. So you want to think about when and where are you going to use these funds, as which instrument to utilize in those types of ways. So that becomes the first aspect that you really want to consider if your intention is not to spend all your time in the United States. How do the double taxation agreements work? All of those double taxation agreements are listed directly on the IRS website. And otherwise, you can find them in our American Expat Guide on our website, dunhillfinancial.com. The other aspect you want to think about is how you're investing those accounts. Now, any 401k and most any investment advisor in the States is going to have an increased amount of an allocation to US dollar securities. Typical allocation for an American company, an American investment advisor, is going to be between 80 and 90% US equities and fixed income. This is in comparison to 57% of the world's market cap is in the United States. So the difference between the 57% and the 80 to 90% is what we call a natural currency hedge. You own more in the currency that you're going to retire in or need the funds, and that removes one risk, which is currency risk. We're going to be talking more in depth on currency with Kelly. Now, essentially, when we're thinking about natural currency risk, that works perfectly if you're going over there and you're going to retire in the United States. But if you're going to come back to Europe, if you're going to come back to the United Kingdom, even though we've had 14 and a half years where the dollar has actually been outperforming the euro and the pound, maybe a little bit longer for the pound, essentially, we typically have 10 to 15 year periods where the dollar is strong, and then 10 to 15 year periods where the dollar is weak. So you want to take that into consideration, and you might want to remove some of that risk by investing more in non-US dollars and instead investing in the currency that you'll be retiring in. The good news is you can access all these markets in the United States. You don't want to buy them directly from the Frankfurt Exchange or the London Stock Exchange, because then you'll own PFICs, passive foreign investment companies. But you can buy in New York on the New York Stock Exchange indexes or individual securities. They're called American Depository Receipts for companies, or bonds that are allocated in euros and pounds. And therefore you can have that natural currency hedge inside of your portfolio, so that that IRA, 401k, or any other investment, just your general investment account, is more suited to where you're going to need the funds instead of just where you're currently located and investing. Currency should be the hot topic, like I said, 14 and a half years where it's been going one direction. But we have the 50-year history. We put it out in last month's newsletter where we were talking about that 10 to 15-year pattern where it goes one way and the other. I don't want to take the wind out of Kelly's sails, because she's going to go through the whole vantage point of how to move different funds, but I'll give you a little bit of a short-term market commentary because it has been that hot topic. This year, inflation is driving all the markets. It doesn't matter if you're in the bond market, the stock market, the real estate market, everything is being driven by inflation, because all of our central banks are having to raise interest rates to go ahead and try to minimize any of that inflation. Now, in poor form, I'm going to make my bad joke. That's just an easy way to remember how it typically works. And it's basically the order of who gets to go first when it comes to raising rates is typically the US gets to go first. The UK are America's lapdog, so we get to go second. Then Europe goes, Japan does it next. And when China gets around to it, we call them currency manipulators. That's the typical order. Now we've had 3 rate hikes in the United States. We've had 2 rate hikes in the UK. We've had 1 in Europe. Right? Japan hasn't touched anything. And actually, we're actually looking at quantitative easing still kind of in a way in China because, well, they're trying to stimulate the market because of their zero COVID policy, i.e. that waterfall is exactly the same as what we've seen in all of the past rate hikes in the last 50 years. Now, when we have higher rates, if we just think about kind of 1 year CDs, 1 year CDs in America, you can get about 4%, and yet you can only get about 2%, 1.5 to 2% over here in Europe on a 1 year note. So if you think about most people with cash, they're wanting to buy a 4% CD instead of a 2% CD in euros. Hence, the flow of money is going that way. But then you have a currency risk. But Kelly can help you very easily buy a forward contract so that you avoid some of that risk a year out. It only costs you 10% down, which means you can invest 90% of that and put 10% down to hedge the currency risk, and you're getting 360 instead of 2%. Which is why all the flows are going to the United States and why you have that waterfall perfectly intact. The dollar will quit going up when interest rates are not as high in the United States as they are in Europe and the UK, i.e. when the UK and Europe get to move up faster than the US. So as soon as inflation is curbed in that way, that will help things in a significant manner of getting back to even. And then we might have a 10 to 15 year flow of dollar weakness. But the important part when it comes to currencies, especially if you're making those big purchases, is not spending money on big fees and getting some guidance in working with foreign institutions. So Kelly, do you want to take us through how MoneyCorp might be able to help some of these individuals in those big purchases?
Of course, I'd be happy to. Thank you so much. Well, as Hugo mentioned, my name is Kelly Cutchin, and I am the country manager for MoneyCorp here in North America, and I've sat in this position since 2012. However, I did join MoneyCorp and jump into this industry back in 2006. So I'm 16 years under my belt with experience, and my primary focus over those 16 years has always been to work with individuals, right? These are individuals that are either buying or selling real estate, they're immigrating, but they have a reason to transfer funds from one country to another. So I'm going to go into a bit more detail on some of the best practices on making those international transfers that are probably a bit different than maybe what you've initially thought were the best ways to do these types of transfers. So a little backstory on MoneyCorp. We are actually a UK-based company, but again, put an office out here in North America back in 2006. We were incorporated and began trading in the late 70s. Last year, we did transactions for over 9.2 million individual customers, and that equated to approximately $20 billion in foreign currency transactions. Again, we've got offices around the globe with dedicated employees in each of these regions. And I think last year we did transactions between somewhere in the region of for 90 different currency pairs. So the information that I'm going to take you through today, I'm kind of going to focus on maybe the British pound and the US dollar, but do consider that the same information is relative regardless of the currency pairs that you're looking to transact and regardless of which direction you're looking to transfer your funds. So again, we do have offices worldwide, whether you're in the UK, Europe, Asia, here in North America, we do have local representation that can help you. And again, some of the reasons above and beyond real estate and immigration why you might find a need to make a transfer might be for a long-term investment. You may be selling off an asset. You may be sending children to study abroad, or you may still have expenses back in your home country, property management fees. You may need to replace air conditioning, who knows, new roof, you name it. But if you do have an international payment requirement, then a service like Money Corp or another using a currency exchange brokerage might be the best fit for you. So the first thing I'm going to sort of delve into is the actual exchange rate itself, right? So there's something known as the interbank rate of exchange. So this is the exchange rate that big banks are buying and selling millions of dollars of currency at any moment in time. But it's not actually the exchange rate that you or I or any of our clients would actually have access to. So to put this into context, the current interbank rate of exchange between the British pound and the US dollar is around about 1.13. So 1 British pound will get you approximately 1.13 US dollars at this moment in time. However, if you were to contact your high street bank, what they're going to provide you is an exchange rate that has got a margin built into it of around 4%. Just to elaborate on that a little bit, there's a lot of things that dictate the actual margin that a bank will provide to you when they give you an exchange rate quote. And I'll give you an example. If you were in Canada and needed to move funds out of a Canadian bank, their margins are not that bad, if I'm honest. Their margins are typically ranging between 2 and 3%. UK banks, typically that 4% mark is a pretty common margin that the bank is taking. European banks, again, around 2 to 3%. But US banks, it's not uncommon for them to offer you an exchange rate that is anywhere from 6 to even 10% off of what the true value of an exchange rate is. So the context here is to ensure that you are shopping around and making sure that you're finding the best possible rate of exchange for you, because there is likely a company that can get you really close to the true exchange rate. So to put this into context as well, let's say that you now reside in the United States and you've finally decided to sell off some of your UK assets. So in this example, we're going to sell our property in the UK and bring those British pounds here to the United States. So we're going to sell 100,000 British pounds and bring those here to the US. If you use your bank in the UK, you'll probably end up with approximately 108,000 US dollars. And that's because they took that 1.13 exchange rate. They took a margin of 4%, so they sell that currency to you at an exchange rate of 1.08. So that's where the bank is really truly making their profit, which is a hidden profit or a hidden fee to you. If you went through a currency exchange broker who would take a margin of less than 1%, that's Money Corp's typical margin, then instead of getting an exchange rate of 1.08, we could offer you a rate of 1.12, meaning you're going to end up with approximately 112,000 US dollars. So again, just by picking the phone up to a brokerage versus your bank, you're going to end up with approximately 4,000 more dollars in your American bank account than you would if you just went through your UK bank. And again, as I mentioned, this is the hidden profit that the bank will charge you. Because of course, if you contact your bank and you mention to them that you want to make an international transfer, they will likely tell you that there's just a small fee to do so. Normally, banks charge an international transfer fee of somewhere in the range of $25 to $50. So you go, well, on a $100,000 transfer, $30 is not, that big of a fee. Let me just pay it and be done with it. But again, you can, in your mind, know that that's approximately $4,030 that the bank will be profiting off of your transaction. So this is really, really, really important. So do make sure that you're considering other options before you make any international transfers, regardless of the size, right? So yeah, we're talking about a big chunk of change with £100,000 transfer. But if you're going to transfer $500, again, a savings is a savings, and there are companies out there that can help you save substantial funds. The other thing that Brian sort of talked about a little bit was about the volatility in the market. And okay, we have seen this trend of the US dollar strengthening over the course of the last decade or so, but anytime there is a trend one way or another, there are going to be peaks and troughs, right? So it's sort of like a roller coaster. As Hugo mentioned, I'm here in Orlando, Florida, so I'm going to relate this to a roller coaster that's going up and down, and at the end it might be that upward trend, but you want to make sure that you're taking advantage of the favorable exchange rates when they present themselves. So working with a company that can help you target a specific rate of exchange is a great resource for you. But again, having the ability to lock into an exchange rate for up to 2 years might be massively advantageous. And as Brian mentioned, to lock into an exchange rate for up to 2 years, there's no cost, but you do need to put forward a 10% deposit, which offsets the total amount that you want to transact. The other 90% continue to keep those funds into other investments, continue to hold those funds in your interest-bearing accounts if you have an interest-bearing account at this point. But again, you only need to tie up a 10% deposit in order to secure a rate of exchange for a future delivery date. Then you just send the other 90% on or before the day in the future that you want those dollars available, and we will deliver those dollars to the bank account of your choice. So again, consider locking into an exchange rate if you know that you're going to need to do a transfer in the future and have a future date in mind. One of the questions that we're often asked is what impacts an exchange rate? And while we can sit here and we can talk about interest rates and economic performance, there are certainly some things that are not predictable, right? Things like natural disasters have an impact on the exchange rate. Even the pandemic had an impact on the strength of the US dollar and subsequently the exchange rate between one currency and another. So, work with a company that's going to provide you with guidance, keep you abreast of these global affairs that are going to have an impact on the exchange rate so that you as an individual and a family can make the best decisions on what rate is realistic to target, when is the best time for me to facilitate a transfer, and is it the right time for me to lock into an exchange rate and secure that rate to eliminate the risk of it fluctuating against you between now and that future date that you require those funds. The last thing that I wanted to kind of touch on, which is really important, and it's something that I'm very passionate about, is here in the US, it's called the United States Patriot Act, which basically states that you are unable to facilitate an international money transfer without being physically present in your branch. And more banks globally are beginning to have similar rules, right? So make sure that you are asking these questions prior to leaving a country or prior to moving any money around, because you do run the risk of your funds getting stuck in a bank account if you're not there to access those funds. So I'll give you an example. Throughout the pandemic, we had a lot of foreign nationals who owned real estate here in the United States. They lived in the UK and they wanted to sell that US property and convert the funds back to the UK. What was happening at an astronomical proportion is customers were selling their real estate, having the title companies deposit the funds into their local bank accounts. But then when calling Bank of America, SunTrust, Wells Fargo, they were telling these customers that were currently abroad that they could only access their funds if they could visit the branch. Well, hello, there's a pandemic. There's no flights coming into the United States. Their funds were stuck. So there are better routes to follow, but again, don't complete the action and then realize that there was a better plan. make sure that you're planning ahead. Effectively, what we would suggest that you do is have your funds or your proceeds deposited directly into an account with MoneyCorp or into a currency exchange broker of your choice. But that way you can pick up the phone and you can access those funds anytime, wherever you are in the globe, without needing to be physically present. Same if you're here in the United States and you have funds back in the UK. Again, perhaps you want to have the solicitor send your proceeds directly into your MoneyCorp account versus making that pit stop into your UK bank, because then you do run the risk of those funds getting sort of stuck there or having to use them to make your international transfers, which I already explained isn't a great idea because of the exchange rate. So again, ask the questions before you transfer any funds anywhere to make sure that you're aware of any potential risks that unfortunately happen if you're not prepared. If you are interested in setting up a free account with MoneyCorp for any international transfers, feel free to visit our website, or I believe you can reach out to us by the contact information that's provided there, and we can help you sign up for a free account and speak to a currency exchange dealer, right? Find out what the rate of exchange is that we can currently offer. Compare it to the rate that is being offered by your bank so that you can truly feel and see the actual savings that you could obtain on these types of transfers. Again, our contact information will be shared with you. Use the team here as a resource or a tool, whether it's for your tax questions or investment options, and of course, for your currency exchange and international transfer needs. We're here to support you.
Thanks very much, Kelly, and thanks all of you. That was super useful and informative. Before we jump into a Q&A, I'd like to just introduce everyone watching to a robo-advisor investment solution. If you're an expat in the US, just starting out on your investment journey, and it's called DF Direct. That was a short video about DF Direct, and you can find out more about DF Direct at df-direct.com. Okay, now we've had a few questions come in, and the first one is for Drew. And the question is, can I make contributions to an IRA as well as to a 401k?
Yeah, that's a good question, and one that we see pop up frequently. The short answer to that is yes, you can do it, but of course, you have to do it within the IRS limits of what your total contributions can be. So the answer is yes. Why you may want to do that goes back to the whole idea that, you know, there could be investments options outside of the 401k that could complement what you have in the 401k and expand on what you have on the 401k. So you may want to use the 401k and the IRA to get a more broader investment portfolio for your retirement.
Okay, so another question here says, what's a target date fund?
Okay, yes, target date funds have become popular over, well, probably the last 10 years, especially as the government policy has tried to encourage people to make contributions for their retirement. Believe me, the United States is keenly aware that most people are not saving enough for retirement. And one of the hurdles that they felt was that, well, if you get into a retirement plan with a 401k, these are really self-directed. It's the burden is on the individual by and large to make the investment decisions. So what's become popular over the last 10 years or so is creating these types of portfolios, these mutual funds that are really a fund of funds. It's a mixture of mutual funds that are intended to make it easy for somebody to make an investment, assuming that they're going to retire at a certain date in the future. So, we're here in 2022. Let's say I've got 40 years to go till retirement because of whatever age I'm at. And so what I might do is do a default target date retirement fund of 2066, something that it says in the title 2066, or it might be something very close to that. So they have become more and more prevalent, but especially in the what we've seen in the stock market over the last year or so, they've actually come under a lot of scrutiny. I'm recalling an article from Barron's back in June that described this group as having mediocre performance and high fees. So that doesn't mean that if you enroll in a 401k plan and they have that as an investment option, that doesn't mean that yours will provide you mediocre performance or be expensive, but it does suggest to me that you need to analyze that a little bit more than you would. Well, no, all your investments should be reviewed and analyzed, but don't assume that just because you're put into a target date fund that's the right thing for you. And we talked about auto enrollment earlier and how you probably need to goose up the amount that's being withheld from your payroll to actually fund your retirement. Also, the auto enrollment typically use these target date funds. So make sure you take a look at whatever you're invested in within your 401k. So I hope that answers the question.
Thanks very much. Yeah. There's another question here, maybe for Brian, and it says, if I'm going to retire back in Europe, does it still make sense to invest in the US while I'm working here?
Absolutely. While you're in the US, you want to avoid those PFIC issues. So you want to be investing on a US based account. That keeps you in full compliance on the US side. Even when you get back to Europe, if you're still a W-9, so still a US person, you're going to want to keep your accounts like that. You just might want to change the actual currency inside of it. Depending on the country, in other words, how the double taxation agreement between the United States and Europe works, you might want it to be inside of an IRA, as Drew was talking about earlier, or if you're going to go back to countries like Germany and Spain, you might want to instead just opt for it to be a general investment account or find a way to make distributions out of the account while not being a German resident or not being a Spanish resident. So it's looking at it in a multifaceted way. But as Drew astutely stated, most people have underfunded their own personal retirement accounts, and therefore not doing anything, having analysis paralysis with all of this is the worst thing that you can do. I've seen statistics that it's only essentially a single digit of percentage of people will actually live better in their retirement than their working years. And the whole reason to have this type of a session is to make sure that people aren't using the fact that they're an expat as one of those reasons for being the majority, which are going to live on less in retirement than they did there in their working years.
Thank you. A couple of currency questions as well. The first is, if I'm going back to Europe to visit, does it make sense to use MoneyCore to transfer some money just for my visit into Europe?
That's a very common question that I could answer. So with when doing an international money transfer, we will need a bank account to transfer the funds into, right? So I'm here in the United States. I want to take a holiday back to Europe. I want to convert call it $500 into euros to use while I'm there. If we do that transaction, again, we'll need a European bank account to deposit those euros into. And the reality is most travelers don't have those international accounts available. Now, let's say if you're visiting a friend or a family member who's going to pick you up from the airport and you trust this person, then of course we can help you transfer funds into their bank account, and then they can provide you with those euros upon your arrival. But again, that's in a unique scenario. My recommendation for traveling per se would be to plan on using your credit card. Do call around your different credit card companies to see who charges the least fees, and of course use that card while you're traveling, or go to a bank in Europe that is within your banking network and use their ATM to debit the local currency whilst you're there. Avoid, where possible, converting physical cash at an airport or a bureau de change, because the exchange rates are quite hefty, right? So the exchange rate that you will receive at a bank or a currency exchange booth will not be all that favorable. It's a convenience, thing to have actual cash. But bear in mind as well, if you don't spend all of that cash while you're there, you're then going to get hit again when you convert those funds back into US dollars when you return home. So again, using a credit card or debiting funds from a local ATM in the country that you're visiting is probably a better way to convert physical cash. And of course, if you did have a bank account internationally, we could of course help you wire funds into that bank account.
That's great. And last question, I think, is what's the best way if you have to pay regular small bills in your home country?
That's a great question as well, and something that you'll want to have a further discussion with a dedicated currency expert who can look at the big picture and help you to determine, do you want to take advantage of today's exchange rate and lock into that rate for your payments for the next 2 years? Do you want to go ahead and prepay or pre-fund 6 months of your expenses based on where the current exchange rate is? Or do you not like today's exchange rate? We feel like it's going to improve for you. So let's just kind of cover month by month until such a time that we hit a favorable rate of exchange, and then let's lock it in. So we do have options to directly debit your international bank accounts and at a fixed exchange rate, make those global payments for you. But there are so many options when it comes to making regular payments that, again, speak to your currency expert and come up with the best plan for you and your family.
Kelly, I have a question for you, if you don't mind. Currency exchange has very much been in the headlines. And, we all know the strength of the US dollar versus the other currencies around the globe. It's unique, I believe, how quickly it's gained this strength over the last year or so. Where are you seeing the most transfers? Are you seeing money leaving I'm assuming you're seeing money leave the United States and go to Europe. What are the people doing? Assuming people are doing this, what are they doing with it? Are they buying real estate, or are they just buying it to hold it? So when there's an eventual recovery, they'll do an exchange back. Are you noticing a trend at all?
As a global company, we're seeing lots of transactions going in every which direction, right? But for us here in the United States, the majority of the transactions that we're seeing at this moment in time are people selling US dollars to purchase foreign currencies, right? Dollar strength. Also, there's other things happening in the world that are driving Americans to actually consider an international investment in the likes of real estate. So just the hot trend at the moment that we're seeing are a lot of residents in the United States are looking to purchase second homes or even retirement homes in Europe. You have a moment in history where the US dollar is actually worth more than the euro. We have inflation, and our property values have just skyrocketed over the last several years, making it a real opportunity for many people to sell off those US investments and actually convert their funds to euros and purchase a property in the likes of France or Portugal. We're seeing clients look into specific visas, which again is a whole nother discussion. But again, there's many countries that offer specific visas for making substantial investments into their countries, like the Golden Visa in Portugal. So again, that's kind of the big trend that we're seeing right now is US dollar sellers and euro purchases. But hey, we're in the Sunshine State, so I've got Canadians ringing every other phone call looking to buy real estate down here in Florida as well. So it is a big mix, but certainly seeing a lot of dollar sellers right now.
Thank you.
Oh,
Thank you. That was good.
And thank you to all of you, to Drew, Brian, and Kelly. And thank you all very much for tuning in and watching today. I hope the information was useful. If you have any follow-up questions, we'll email you our experts' details, contact details, or if you're watching this on YouTube, check out the description below. We have another online financial event for expats in the US planned at the beginning of January, which is just a couple of months' time now, on Wednesday, January the 25th, 2023, on US tax filing strategies for expats in America. Again, we'll email you a registration link, or if you're watching on YouTube, we'll put it in the description below. We look forward to seeing you again there. And that about wraps it up, I think. So thank you very much to our experts, and see you all next time.
Thanks so much, Hugo.
Thank you, Hugo.
Thank you.